Welcome to Financial Statistics. Have you ever worried about how unpredictable prices might affect a future purchase? Today, we are going to explore a powerful financial tool called a forward contract. It is a simple but brilliant way to lock in a price today for something you will buy or sell months from now, completely eliminating the stress of market uncertainty. Let us dive in. To understand what a forward contract is, imagine you own a bakery. You need a massive amount of flour in 6 months, but you are terrified the price of wheat might skyrocket. To protect yourself, you agree with the farmer today to buy that flour in 6 months at a locked-in price. You do not pay today and you do not get the flour today. You simply make a binding promise. This is exactly what a forward contract is. It is a customized agreement between two parties to buy or sell an asset at a predetermined price at a specified time in the future. Because no money changes hands initially, the contract starts with a value of exactly zero. Now that we understand the basic idea, let us define the formal terminology used in financial markets. The item you are agreeing to trade, whether it is flour, gold, or company stock, is called the underlying asset. The exact date in the future when the exchange happens is the maturity date. When you enter this contract, you take one of two sides. If you agree to buy the asset, you take a long position. You will be happy if the market price goes up because you get to buy it at your cheaper locked-in price. Conversely, if you agree to sell the asset, you take a short position, meaning you benefit if the market price drops. As you study financial markets, you will often hear the terms forward and futures used together. While similar, they have crucial differences. A forward contract is a private, over-the-counter deal. This makes it highly customizable, but it introduces credit risk, meaning the other person might default on their promise. A futures contract, on the other hand, trades on a public exchange. It is highly standardized, so you cannot customize the size or date. However, the exchange acts as a middleman, completely eliminating credit risk. Furthermore, futures are settled every single day based on market movements, whereas forwards are only settled once at the very end of their life. This brings us to a critical question. How do we determine the fair forward price today? We cannot just guess. We rely on a foundational concept called arbitrage, which means making a risk-free profit without using your own money. Imagine you want to own a stock in 1 year. You could enter a forward contract today, or you could borrow money from a bank today and buy the stock right now. Since both choices result in you owning the stock in 1 year, they must cost exactly the same amount in the future. If they did not, clever traders would exploit the difference for free money. This balance dictates the forward price. Based on that no arbitrage principle, we can derive the mathematical formula for an asset that does not pay dividends. The forward price F is simply the current spot price S grown at the continuous risk-free interest rate R over the time to maturity T. The letter E represents the mathematical constant for continuous compounding. Think about what this means physically. If the current spot price increases, the forward price must also increase. Similarly, if the interest rate or the time to maturity increases, the cost of borrowing money from the bank goes up. This higher borrowing cost directly drives the forward price higher to maintain that perfect balance. Let us put this formula into practice with a concrete example. Suppose a non-dividend paying stock is currently trading at a spot price of $50. The continuous risk-free interest rate is 6% per year, and we want to find the fair forward price for a contract maturing in exactly 6 months. First, we identify our given variables. The spot price S is 50. The rate R is 0.06. We must convert the 6 months into years, giving us a time T of 0.5 years. We then substitute these exact values into our foundational no carry forward price formula, setting up our equation for the next step. Continuing with our calculation, we first simplify the exponent by multiplying the 6% annual rate by the half-year time period. This gives us an accumulated interest rate of 0.03. Next, we evaluate the exponential function, which gives us a continuous growth factor of approximately 1.03045. This tells us the cost of borrowing will increase our total cost by about 3%. Finally, we multiply this growth factor by our initial $50 spot price. The final calculated forward price is exactly $51.52. This is the perfectly fair price to lock in today, ensuring no trader can make an unfair arbitrage profit. Now that we have priced a basic contract, we must ask, what happens if the underlying asset pays cash while you hold it? Many stocks pay dividends, which are cash rewards given to shareholders. If you buy the stock today using borrowed money, you will receive these cash dividends while waiting for the maturity date. You can use this extra cash to pay off a portion of your bank loan early. Because this effectively makes holding the stock cheaper, the forward price must also be reduced. If we did not lower the forward price, the balance would break and arbitrageurs would step in to make a risk-free profit. To adjust our pricing for these cash payouts, we modify our formula. We must first calculate the present value of all expected dividends, which is simply the value of those future payouts measured in today's dollars. We denote this as PV div. We subtract this present value directly from the current spot price, S, because receiving dividends lowers the net cost of buying the asset today. The rest of the formula remains exactly the same. We grow this reduced net cost at the continuous risk-free rate over the time period. Notice that as expected dividends increase, the present value term gets larger, which directly causes the final forward price to decrease. Let us see how this works in a real-world scenario. Suppose a stock is trading at $100 with a risk-free rate of 5%. The contract matures in 6 months, but the stock will pay a $2 dividend in exactly 3 months. Our first major step is to find the present value of that $2 dividend. We discount it back from month 3 to today using the continuous interest rate. We multiply the $2 future cash flow by the negative exponential discount factor. The negative sign is crucial because it pulls the future value backward in time. We use 0.25 for the time, representing the 3-month wait. Continuing our calculation, the exponential discount factor evaluates to approximately 0.9875. Multiplying this by $2 gives a present value of exactly $1.975. This means receiving $2 in 3 months is mathematically identical to holding $1.975 right now. We now substitute this value along with our $100 spot price into our adjusted forward price formula. Subtracting the dividend's present value gives us a net effective spot price of $98.025. Notice that we are now only paying interest on this reduced net cost, not the full original stock price. In our final steps, we evaluate the continuous growth factor for the full 6-month lifespan of the contract, which comes out to approximately 1.0253. We multiply this growth multiplier by our net spot price of $98.025. This brings all our adjustments together, giving a final fair forward price of exactly $100.51. Notice that if there had been no dividend, the forward price would have been significantly higher. The expected cash payout effectively lowered the cost of holding the stock, which perfectly illustrates why cash flows must always be accounted for in derivative pricing. Now that we know how to price them, let us look at why forward contracts are so vital. They are the absolute backbone of risk management in the modern global economy. Without them, businesses relying on physical commodities would be at the mercy of unpredictable market swings. For example, an airline company needs millions of gallons of jet fuel. If oil prices suddenly double, they could go bankrupt. By using a forward contract, they lock in their fuel costs for the next year, ensuring stability. Similarly, a farmer planting corn today can lock in a selling price for the autumn harvest, guaranteeing they can feed their family even if market prices crash. To visualize this risk management, let us look at the payoff diagram at maturity. The horizontal axis shows the actual market price of the asset when the contract expires, while the vertical axis shows your profit or loss. The upward sloping blue line represents the long position. If you agreed to buy, you start making a profit as soon as the market price rises above your locked in forward price, because you are buying a valuable asset at a cheap rate. Conversely, the downward sloping red line represents the short position. If you agreed to sell, you make a profit when the market price drops below the forward price, because you get to sell a cheap asset at a high locked-in rate. Let us summarize the key takeaways from our exploration of forward contracts. First and foremost, these contracts are powerful tools that allow two parties to lock in a future transaction price today, completely eliminating the anxiety of price fluctuations. Second, we learned that the fair forward price is never a guess. It is always calculated using the strict principle of no arbitrage, ensuring no one gets an unfair advantage. Finally, we saw that any expected cash flows, such as dividends, effectively lower the cost of holding the asset, which in turn reduces the forward price. You now have a solid understanding of how forward contracts function in the real world. Excellent work.